Here's a query. What's the difference between a broken stock and a broken company? Broken stocks are easy to fix. They often bounce back on their own, which is why they can make such compelling buying opportunities. But broken companies, nope, they take forever to turn, and in the meantime, their stocks tend to be very hazardous to your wealth. Right now, we've got a bunch of busted growth names. So I want you to be able to distinguish between the buyable broken stocks and the uninvestable broken companies, two very different things. So let me give you a textbook example. I want you to look at Square, SQ, the rapidly growing payment technology company that's been a long-time Cramer fave. For years, this stock was one of the best performers around. Sure, it got hit hard during the massive market-wide meltdown at the end of 2018, but then it came roaring right back. As recently as August 1st, Square was trading at $83. That's up nearly 50% for 2019. But then it crashed headfirst into a retaining wall after reporting a quarter that Wall Street wasn't really exactly thrilled with. The stock plunged to $69 the next day. And you know what? Well, as you can see, it's been sinking ever since, down to $59 as of today. Suddenly, this former market darling, it has become a complete battleground stock. So, I mean, I sit here and I look at it and I do have, I have remonstrations and ruminations that, of course, I should have told you to take some profits there. And I didn't. It's my bad. But as much as I like to pretend this breakdown never happened, we have to address it head on because this show is all about accountability. Plus, more importantly, we need to figure out whether Square's an enticing broken stock or a repulsive broken company. So let's set the scene. Now, 2 months ago, Square seemed like a powerhouse. They built a huge payments network, and thanks to their little credit card readers, you've seen them, like the little white things, okay? You plug them into your smartphone, and it turns you into a point-of-sale terminal. Even better, because Square is a great read on how much money its clients are making. After all, they're basically running the cash register. The company's got a rapidly growing money lending operation, Square Capital. No bank has that kind of insight into their borrowers. And since Square controls the payment system, if you borrow from them, they can just take the interest payments right out of your receipts. Now, until very recently, the financial tech companies, their stocks were red hot because hedge funds were worried about an economic slowdown. These portfolio managers need to have some financial exposure because the sector is such a huge part of the S&P. But the banks tend to perform badly in a recession, so they swap into the red-hot fintech stocks. They swap into Square. However, over the past couple of weeks, the recession fears have subsided. You saw that with interest rates going higher. And so, therefore, fintech, it's gone out of style. But Square was getting hammered long before the rotation was going on. So what's driving the weakness? Okay, I think that this is a management issue, but it's really a cosmetic management issue, so don't get scared. Square's always had an unorthodox CEO, Jack Dorsey. He also happens to be the CEO of Twitter. Now, I used to joke that he was a part-time chief executive. And you know why? And you know what? It didn't matter. Not as long as Square had a fantastic chief financial officer, Sarah Friar. Hey, you might have seen her on Scott Wapner's show the other day. She was fabulous. And, well, Sarah was keeping her eye on the prize. Dorsey hired her away from Goldman Sachs in 2012, and I still think that may have been the best management decision he's ever made. She was just that good, and is that good. Going next door, though, because she left Square, and you know what? Here we go. 11 months ago, we don't really have anyone that's standing out as taking that company over, which I think is a lot of the reason why you're seeing this, okay? The stock did get eviscerated when Sarah left. Wall Street trusted her, and that's what mattered because she had a very clear head. She'd been a brilliant person at Goldman. I don't really put any disrespect to her successor, Amrita Ahuja, who came over from Activision Blizzard. But analysts and institutional investors have become a lot more skeptical since Friar left. I actually opined that I thought they would have enough bench strength, and that's where I really got it wrong, or at least the way the stock market got it wrong. Since then, every time Square has reported, they deliver solid headline numbers before giving confusing or even disheartening guidance. That's what happened in late February. And while the stock's initial reaction was erratic, the darn thing spent the next 3 months steadily sliding lower. Fast forward to the next earnings report in May, and once again, Square tripped over its own feet. While the company posted a nice top and bottom line beat, they only reaffirmed their forecast rather than raising it. That's what you need. Need your stock to go higher. And the guidance for the next quarter was weaker than expected. And that's why the stock spent the next month steadily sliding lower before bottoming at $60 in early June, roughly the level where it's trading now. But over the course of June and July, Square surged higher, back above $80 on very little news. You had some positive analyst chatter, and of course, you had that fintech bull market I just mentioned. It felt like maybe Square was out of the woods. Then the company reported after the close on August 1st, and you know what? That is when the wheels fell off this bus. This time we saw the same darn pattern, better than expected earnings, better than expected sales, but they left the full-year forecast unchanged and then gave conservative guidance for the next quarter. Literally the same thing that happened in May, except with stronger headline numbers. On top of that, Square told us they'd be getting out of the food delivery business. Management's selling their delivery service, Caviar, to DoorDash for $410 million. Now, I think they got a fabulous price, kind of unbelievable. And I'd say that as a Caviar client at both my Brooklyn Tavern bar, San Miguel, and our restaurant, The Longshoreman. Believe me, you don't want to be in the online delivery business. The margins are cutthroat. But this time, Wall Street finally ran out of patience with Square. Money managers were sick and tired of good quarters and then conservative guidance, which is why the stock dropped 14% the next day and just kept falling. And that's how it's broken down to below 60. Plus, it hasn't helped that the turbocharged growth names like Square, they've gone out of style now that investors are rotating to the more economically sensitive stocks that will really benefit from more rate cuts, although today was a bit of a respite from that. So what the heck are we supposed to do with this thing, with this one-time market darling? What goes on now? All right, last Tuesday, 3 different analysts published some seriously contrasting opinions on Square. I always like to canvass the analysts to get a sense of what the bulls and bears are thinking. On the bear side, Atlantic Equities initiated coverage on Square with an underweight or sell $55 price target. This is part of a broader note on the fintech space, where they see Square as one of the least attractive players because its core business, they think, is decelerating. While the company's trying to expand its consumer payments with its Cash App, something I really like, the guys at Atlantic, well, they just think the future's uncertain for that business, which they think is full of strong competitors like, yes, Venmo. Remember PayPal? On the bull side, though, Square caught a pair of upgrades, one from MoffettNathanson and then the other from SunTrust. Lisa Ellis at MoffettNathanson, a brilliant analyst, gave it a buy recommendation, $85 price target. She argues that the stock has gotten too cheap. She likes the strength in Cash App, yes, and she agrees with me about selling Caviar. Bye-bye. How about SunTrust buy recommendation with $80 price target? They see Square investing heavily to take share in larger, more complex retailers and restaurants, not their current bread and butter, and they view the Caviar sale as the first step in this repositioning. That would only be just okay. People don't like to hear spend, spend, spend. Where do I come out? I agree with Lisa Ellis from MoffettNathanson. Square used to be extremely expensive stock, but now it sells for 8.3 times next year's sales and 53 times next year's earnings estimates. I know. I hear you. Yes, that is high, 8 times sales. But listen, given that the company has a 46% long-term growth rate, I'm calling it reasonable relative to its growth rate. Here's the bottom line. Square's fundamentals are sound. It is sound. I know this. It's not a broken stock. I mean, let me clarify that. The stock is broken right here, but it's not a broken company, which means you can absolutely buy this one. And I'm going to tell you, I think you can buy it now. Worst case, it goes down some more and the stock gets even cheaper. I just wish the new CFO could tell the story as well as Sarah Fryer used to. If they did, because the company isn't broken, just the stock, it would be a heck of a lot higher. Stick with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.